in the last week, we've seen very extraordinary and aggressive easings of monetary policy. The Federal Reserve cut interest rates down to equal to the lowest levels that it's historically had. It again resumed quantitative easing. This is enormously expansive monetary policy. And yesterday we saw the Reserve Bank of Australia follow the Federal Reserve's game. The RBA first cut the cash rate to 25 basis points. But what it did together with that was it issued guidance. And the guidance was that the cash rate would not be increased until progress is made towards full employment, and it is confident that inflation will be sustainable within the 2 to 3% inflation band. Now, what that really means is I think we've got, even if we have a decent recovery in the second half of the year, which I think is very likely, that we are going to have these very, very low interest rates until we get a sustained recovery in inflation. Now, it takes around about a year and a half for the level of unemployment to feed through to the level of inflation. So that means we could have these very, very low interest rates sustained of 25 basis points right through to the end of next year. The second thing that the RBA did was that, in its words, it issued a target for the yield on 3-year bonds of around 25 basis points. And in saying so, began a program that we have been suggesting since last November that it would undertake, and that is a program of quantitative easing. It says this will be achieved by purchase of government bonds in the secondary markets, Purchase of government bonds and semi-government securities across the yield curve will be conducted to achieve this target. Now, what's really interesting about that part of the statement is they talk about semi-government securities, which means as well as buying Australian government bonds, they are going to buy state government bonds as well. Now, that's really important within the construct of the Australian Constitution, because within the Australian Constitution, work on infrastructure is a state responsibility. So what the RBA is telling us up front there is prepared to buy bonds from state governments to support any expansive infrastructure programs that those state governments want to undertake. And I think that function of the RBA's quantitative easing, which is different in Australia than it is in other countries, I think that's going to have a major effect on the recovery of the Australian economy. And third, the RBA announces a term funding facility for the banking system, with particular support for credit for small and medium-sized industries, and that will be a minimum of $90 billion. I was really interested in that target because, and I've since heard expenditure of $100 billion or so, because that seems to me that compared to the size of the Australian economy, that's around about $1.5 trillion. So $1.5 trillion in the US is equal to about $100 billion in the Australian economy. So what it seems to me is the RBA's action is being scaled to the size of the Fed action to reflect upon that. What was different about this presentation by the RBA yesterday, as opposed to the presentation I went to by Governor Lowe outlining how quantitative easing would go, he gave this presentation to the Australian business economists last November, was that at that time he said that the deposit rate, when the cash rate got to 25 basis points, the deposit rate for banks would be zero. He's now providing a rate of about 10 basis points. Now, I said earlier in the week that the effective funds rate for the Federal Reserve was to be at 8 basis points. So what really this deposit rate is doing is linking the level of money that the banks will receive to a similar level that's in the United States. I said yesterday in the piece I put out that this expansive monetary policy would be enormously beneficial for domestic demand in the Australian economy because the two, in the piece that I said, the two most important parts of the Australian economy, if you just look at it in simplified form, exports of iron ore, which are very strong, still very strong right now, and the domestic housing sector. And the domestic housing sector is really driven by the real level of interest rates. So this level of expansion will, as we come out of this period in the second half of this year, when we are through the health issues of the coronavirus, that will generate enormous expansion for dwellings, both new and existing dwellings, and that will generate a very strong recovery in domestic Australian demand as we emerge from this emergency.